There has been one dividend ETF which has captured the attention of individual dividend investors like you and me. No, I'm not talking about JEPI, JEPQ or QYLD. I am talking about SCHD. If you're a dividend investor, you will have seen the videos popping up about SCHD. They promise so much. A simple, easy way to get rich. All you need to do is buy SCHD and keep buying. Of course, they never talk about the risk or the chance that SCHD can do badly. I mean, everybody knows that the future will be exactly like the past, right? The fact that we're entering a new era in investing with interest rates being the highest in 2 decades will definitely not make any difference. That's what a lot of people say. However, let's look at the facts. SCHD is a passive ETF which was established in October 2011, just as the recovery in the US stock market started taking place. Over the last 10 years, SCHD has had a total return of 162.8%, which includes reinvesting dividends. Over the same time frame, the S&P 500 has returned 30% more and has almost always done better. SCHD tracks the Dow Jones US Dividend 100 Index, which means 2 things. 1. SCHD has really low expenses, just 0.06%. In fact, SCHD is one of the ETFs with the lowest fees on the American market, and that is extremely important. Fees can really add up and eat into your investment gains over the long term. Having low fees means that there's no greedy bankers squeezing every possible penny from your hard-earned savings. It means that your money actually works for you, not someone else. That's really why passive investing has gained so much popularity over the recent years. But there is something else about SCHD. This dividend ETF selects the cream of the crop when it comes to dividend growth stocks. After checking a couple of boxes like 10 plus consecutive years of dividend payments and a market cap of $500 million. Dividend stocks are selected based on a few fundamental criteria: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. No single stock can amount for more than 4% of the portfolio either. No single sector can account for more than 25% of the ETF either. In the end, you end up with a wide, diversified portfolio of about 100 stocks which offer a steady, safe, growing dividend. That's what we all want, right? We want it because it works, and we have seen it work. If we look at the annualized returns of SCHD, we see that since the inception in 2011, the fund has returned an annualized 12.5%. To some, it may sound like a small amount, but this is actually amazing. A 12.5% return means that you double your money roughly every 6 years. Add some patience to the mix and you can become a very wealthy individual after some time. So, what's the issue? So far, SCHD actually sounds like a really good choice. To be perfectly clear, I do think SCHD is one of the best smart beta ETFs out there, along with DGRO. However, there are 2 problems that we can identify. Weirdly enough, they are both a result of the methodology. I know, a lot of investors choose SCHD precisely for the methodology, so I can see why this can be a bit confusing. But there are 2 problems here. First, SCHD does not consider share buybacks. In terms of nominal dollar value, companies in the S&P 500 spend a lot more cash on buybacks than they do on dividends. Over the last 12 months, they've spent $812 billion on buybacks versus $580 billion in dividends. What is more important is that companies are also focusing a lot more on buybacks these days. In this chart, we can easily see that dividends used to be a priority 10 or 20 years ago, but that's not the case anymore. This is partly because of lax regulation, partly because of the advantages of buybacks over dividends. I can immediately imagine people on here arguing that value investors prefer dividends over share buybacks, but is that really the case? After all, even Warren Buffett is a fan of share buybacks. If you don't agree, just look at the times Berkshire Hathaway has paid dividends to investors. Spoiler alert, 0. In comparison, they have continuously repurchased shares. What I'm trying to say here is that one of the problems with SCHD is that share buybacks are not accounted for. It feels like the dividend-only approach is a bit outdated. Okay, maybe calling it a problem is harsh because most people who invest in SCHD do it for the dividend. However, share buybacks tend to lead to higher stock price and also make it easier for companies to raise dividends. By focusing on dividend yield and not total shareholder yield, which is dividends plus buybacks, SCHD could be missing out on some really good stocks. In the short term, the dividend yield alone may give you better results, but over the long term, the combination of dividends and buybacks adds up and tends to outperform. The second problem is that the methodology skews allocation of SCHD to specific sectors. If you know about this and you have considered it, did when buying SEHD, then fair enough, maybe it's not a problem for you. However, my impression so far has been that most individual investors simply buy SEHD and expect dividend growth combined with some capital appreciation. This has worked for the ETF so far, but there could be some problems in the long term. Allow me to explain. Compared to the S&P 500, SEHD has much bigger positions in industrials, healthcare, financials, consumer defensives, and energy. Meanwhile, the S&P has a lot more exposure to technology, specifically Microsoft, Google, Amazon, Nvidia, and Apple. The S&P also has real estate exposure, unlike SEHD, although it's really small, somewhere between 2 and 3%. To me, this is the biggest difference between SEHD and S&P 500. It's the reason why SEHD has struggled behind the S&P in 2023. This really has been the year of the big tech companies. These differences in sectors mean that SEHD is missing out on the biggest investing themes of the next decade. I'm talking AI, cybersecurity, cloud, areas which have such a massive growth potential. In contrast, SEHD is a lot more value-oriented. The stock style focuses on large value stocks, similar to the Morningstar US Broad Value ETF. The biggest positions of SEHD are in Amgen, Verizon, Broadcom, AbbVie, Coca-Cola, Merck. These are good companies with a steady cash flow, but the problem is they lack growth. If you want high dividend growth, you need a cash flow that keeps increasing correspondingly. You cannot sustain 10% dividend growth with a 5% growth in earnings for too long. 10 years ago, companies could have just borrowed at 1% interest and increased the dividend, but that's not going to work anymore. I think this is something that we need to think about as investors looking into SEHD. Now, I know I'm coming across as very critical of SEHD. That's not my idea. I just want to highlight some of the drawbacks and trade-offs of SEHD. Personally, I like SEHD because of its focus on value. The next decade is shaping out to be very tough for the equity markets, and value stocks could make a great comeback. This is why SEHD is definitely a good complement to any portfolio, specifically ones focused on dividend growth. Right now, I think that SEHD also trades at good prices compared to the S&P, which is overvalued because of the rally in big tech. However, as investors in SEHD, we need to be mindful that the growth could be limited. What do you think? Are you worried about SEHD at all? Am I missing something here? Let me know in the comments below. Thanks for watching, and I'll see you again soon.